everybody. This is Michael DeJoy with the Dash Trader Newsroom. Today's we're going to be talking about stagflation, recession, or market rally. What comes next? Is the market going to be able to put in a bottom here and maybe hold its own for a little while? So we'll check that out. And as always, my name is Michael DeJoy. I'm the Director of Educational Services here at Dash Trader. I'm a licensed professional. And I'm joined by my co-host from the Nasdaq market site, Jill Molandrino, Global Markets Reporter. Jill, how are you?
Good, doing well, Mike. Good to see you.
Yeah, we're all back from our 4th of July weekend. Happy Independence Day to everybody. Let's jump right into the news and talk a little bit about the markets. So the markets rise, but so do jobless claims. Are we starting to see some demand destruction caused by the raising of interest rates? What are your thoughts on this, Jill, and how do you think it plays out?
I think interest rates are part of that, but I also think the dynamics that you're seeing in the labor market are also contributing to the rise that we saw in jobless claims. We have seen a number of higher profile companies either cut positions, rescind offers, put holds on hiring. So I think part of that is also due to general market volatility and limited visibility in how long this correction could take place, whether it's market correction or more on the economic side. But I tend to think it's more on the economic side and trying to understand what this is going to look like, what interest rate policy will look like longer term. It seems as if the Fed is keeping a policy in place as of now, but what has propped the economy up and why we haven't been so frantic about recession is the fact that the labor market's been super tight and that the housing market has been so strong. You're starting to see those kind of turn a little bit here, even though interest rates, I think they were as low as they moved down to 5.3%. I'm just double checking here. Mm-hmm. So that could indicate that you are seeing some demand destruction if houses are just sitting on the market or they're not moving. I think also part of that is a lack of inventory as well. Mm-hmm. But I think management teams are questioning just how long this is going to take to correct itself, because Mike, as you and I have been saying all year, any one of the issues, whether it's domestic geopolitics, whether it's Russia, Ukraine, whether it's supply chain, any one of those issues gets magnified by the market. When you have multiples going on at once, it just doesn't, you can't just right that ship. One correcting itself would be a bonus to the market, but there's still a lot of factors in play here.
Absolutely. Yeah. I mean, any one of these under normal circumstances could take down the markets, but now we have almost like 5 different independent, potentially market turning problems that are all kind of intermixed. I mean, I would definitely say, at least from my, my reading of the data, and specifically, I think it was the Atlanta Fed that came out that said, potentially we were already in recession, that the economy had already shrunk, and that would mean that we have inflation and a shrinking economy. That would be stagflation.
Right. So, and you don't really know, you can't confirm, let's put it that way, that you're in a recession until you get the 2 quarters of down readings with GDP. But yeah, anecdotally, you're starting to see people dip into their savings because the cost of goods across the board and gas have gotten so high that that money that was saved through the pandemic, you're starting to whittle away at those savings.
Yeah, I went to fill up my car today, and I had $80 in cash in my pocket. I usually fill it up with cash, and it came out to $82. Like, I have never filled my normal, Nissan Altima up for $82. But that was a little bit of a surprise to me, so I had to go grab $2 more. But needless to say, I mean, it is prices have come off a little bit. We're going to talk about that. The prices at the pump have come down off their highs. And that may give people a little bit of breathing room. But in other news, I mean, we have these geopolitical events. We have Boris Johnson resigning. I mean, he pretty much was the engineer of Brexit. He was the guy who really pushed Brexit to get Britain out of the European Union. And, finally, all of the scandals have added up, and he finally bowed to pressure and has resigned, although he is staying around for a little while. as the prime minister, for at least the next few months. And then certainly at the same time, Boris Johnson was one of the bigger, promoters of of supporting Ukraine. And Vladimir Putin, threatened the West that if it continues to punish Russia for the Ukraine invasion, that there will be, so to speak, hell to pay. So what are your thoughts on all the geopolitical goings on in Europe?
Yeah, you know what? There really was no market reaction to Boris Johnson resigning. I mean, even in the pre-market, it wasn't,
Nothing.
there was nothing. I mean, I got up at I think the headline said at 4:30 and I get up at 5 for work when I have to come into the city. Nothing really happened. If you did not see that headline, you would not have thought anything happened in the market. There was no blip to the up or downside. So it didn't react. I feel like investors are so much more concerned about what's happening domestically as it relates to the economy and inflation, more so than geopolitics this week. Anyway, it always shifts, but I think that we have been living the Ukraine-Russia narrative longer than anyone had expected. And markets and investors sometimes have short-term memory. So while we understand that there are a lot of supply chain constraints on the energy and food side because of Russia, Ukraine, I feel like most of the headlines have really been focused on the macro here in the US.
Yeah, I agree. I think that the Boris Johnson resignation was already factored in. I mean, he's been having scandal after scandal, for the last 2.5 years related to the pandemic and parties and, I mean, you name it, pretty much Boris Johnson had a scandal relating to it. So I don't think that the market, was really too surprised or cared that much whether he stayed in or not. As for, the ranting and ravings of Vladimir Putin, I think the market's kind of gotten used to that as well. The one thing that is a little concerning is that there is 300,000 NATO troops on the border of Russia, which is something that you can't really kind of deny or ignore. I mean, that's a significant amount of soldiers building up, in Europe, to the likes of which I don't remember since maybe 1989. And that's something that obviously is a real serious concern for us all. That brings me to the next topic, which is a concern for us all, and I just talked about it before. What do you do with gas, natural gas, gasoline, and oil prices? Do you buy the dip, or do you, just kind of benefit from lower prices at the pump? I mean, is this a trade opportunity to get in? Is it going to go higher, or has it topped out? And potentially this is where the kind of we start to see the oil and gas prices stay down from here.
Well, even though they have come down a bit, it hasn't been reflected in terms of prices at the point at the pump just yet, which there's always going to be a delay in that. In terms of, has the trend changed? I think it's more of a trade than a trend change at this point. Especially the oil patch is just so predisposed to the headlines that are happening now, as it directly correlates to what's happening in the energy market. It would be nice if we see the trend reverse. It's going to be a pretty tricky winter for those of us in the Northeast and Europe if we're continuing to pay the gases that we are on natty and gasoline right now. And how much relief it can give to consumers at these levels, not that much, but in terms of an investing call, I still think it's more of a trade than I do think it's a trend change. And I would say that for the overall market in general.
Yeah, and there's two things. There's two other factors. I'd love to get your thoughts on this. So, I'm considering going on a vacation with my kids, and domestic flights don't seem to have changed that much. They're not that, like, they haven't gone astronomical, but it certainly looks like international flights have gotten astronomically high. What are your thoughts on that? Is it that the flights, they've canceled so many flights that there's not enough flights?
Right. So traveling this summer is unless it's in a car, is probably something, or unless it's for work, I'm going to take a pass on. I think the fact that the reliability with the airlines and the amount of flights that have been getting canceled might not even be worth it at the end of the day, I do think domestic prices have upticked, and they certainly have even before 2022 is demand came back online. But I think the airlines have a lot to work through. They have to deal with labor shortages. They have to deal with summer seasonal weather patterns here. They have to deal with the fact that they miscalculated just how much demand there was going to be as consumers shifted their spending from goods to services and experiences, and certainly overseas, that's for sure. I was looking at, we were talking about potentially going to Paris over the summer. Our friends have a house there, and the cost of the flights and for the amount of time we're going to be there, it just didn't make any sense. So, you know,
yeah, it's 2,000. It's like $1,500 to $2,000.
It was north of that. It was like mid twos for us. You know, at the end of August is peak for European vacations and so forth, because most of Europe is off. So that's why it's high demand. But I think for the unreliability, if you miss a day or two of vacation because of cancellations or delays, like it's not worth it.
Your 1 week vacation turns into 4 days, and it just throws everything off. Absolutely. The last thing I want to bring up is that we're going into yet again, it's earnings season. So what are your thoughts? I mean, this is really going to be very interesting this quarter, you know, because really it's all about expectations and how we perceive what's going forward and what's going to happen going forward. So I really like to hear your thoughts going into earnings season before, you know, we hear from Netflix and Amazon and all the other big ones that usually start out the season.
Yeah. So what I think is interesting when we were reporting first quarter earnings, of course, in second quarter, just this past quarter, numbers looked good. It was the forward guidance that companies got hit on, because we really didn't see the impact of inflation or what would happen with Russia, Ukraine until Q2. That's when we really started to see reflected in prices for the everyday consumer. So now that we're in the calendar Q3, but we're reporting on Q2, that second quarter, which is coming up in the next couple of weeks, that's where you're going to see the impact of inflation, supply chains, and you know, we've heard a couple of companies pre-announce that they just don't have visibility into supply chains. We know that there is an inventory glut at a number of retailers, which I think is great for the discounters like TJ Maxx and Ross stores. And we have seen that happen before when we've had warmer winters. You see how that translates with that excess inventory to the discounters. But I think, you know, expectations for the quarter perhaps may have been baked in. We saw analysts make adjustments, but I think going forward, there's just not enough visibility.
Absolutely. Well, I mean, to me, I think it's really a somewhat of a crapshoot, this particular earnings season, because it really depends on how the future is perceived, how they're going to. Because I think that this time that we will see the impact of supply chain problems in the actual numbers, but whether that's perceived that it's getting better or getting worse. That's where the initial companies that report are going to have to be closely watched, that they are going to literally set the trend going forward. So like a company like Amazon has very thin profit margins. You know, inflation has a very, very negative effect on a company like Amazon. High fixed cost, you know, transport, fuel costs. I mean, they're pretty much a delivery company that has a lot of, you know, grocery stores. So they have infrastructure, and then they kind of resell everything. So, you know, 10 to 15% profit margins, and you got inflation at, let's just say 8%. It's a difficult one for, let's say, an Amazon. As for Netflix, I'm going to weigh in on the Stranger Things. Will Stranger Things save Netflix? My guess is no. You know, so I think that trend will continue. As for other companies, like, and even Facebook, you know, these companies have really gotten used to 13 years of very cheap money. And that is very, very hard to get over. And I don't think it's going to be sorted out in one quarter.
And Mike, that's an amazing point that you brought up. I had a VC investor from Edison Partners on this afternoon. They focus on healthcare, IT, fintech, and some other spots in the technology space. And he made the same exact point that you did, that for the past 13 years, you have to remember, none of these companies were not public 13 years ago. So that you
Yeah.
have, whether it's entrepreneurs, management teams, and so forth, they have never operated in an environment where there's not free flowing capital. And I
Yeah.
think we need this valuation reset, no question about it. We cannot have unprofitable companies like we saw in 2021 come public. It's just a disservice to the capital markets. And not having the operational experience in a prolonged volatile environment is going to make an impact. It's going to impact capital raise, but I also think that it could shake out some of the outliers. So it can start to get interesting from an M&A perspective on where some of those may be acquired, or what happens is, we look towards capital activity like that. But I also am curious to see what happens with the banks. So we know higher interest rates are positive for net interest margin at the banks, but on the flip side, lending and mortgage activity has virtually dried up. So, and that is, a big contributor.
Big fees in lending and mortgage is absolutely, that's going to be a tough one to swallow for the banks. I mean, so like you think about it, 13 years of quantitative easing. We are in not even year one of quantitative tightening. That is a very big adjustment to make. And, I think that probably this quarter is going to be kind of still up to perception, meaning that it may be perceived good or bad. And it's really kind of how they sell the story. But I think that over the next few quarters, if not the next year or two, that adjusting to quantitative tightening is going to be very, very difficult, a very difficult sell, and a very difficult set of, management teams are going to handle it very good in some companies and not so good in other companies. And also from an investor perspective, at least traditionally, and I'm old enough to remember how to invest prior to quantitative easing, that usually in a quantitative tightening period of time, you really want to focus on companies that have real cash flow, not growth. Real cash flow is king in quantitative tightening.
Right. Well, so we talk about demand destruction, but wealth destruction is also an issue for me as well, because typically you have, your 8 to 10% average years in the market. We had such significant velocity to the upside over the past couple of years that a number of retirement accounts, a lot of savings have just been destroyed. And not being cynical, but being realistic and using history as a guide, to get those kinds of years again in the near future, you're probably looking more at the laws of averages and not necessarily years like that. It's going to take some time to rebuild some of that wealth.
Absolutely, without a doubt. Thank you so much, Joe. It was a real pleasure. It's great to see you back in the market center, and I'll look forward to seeing you in 2 weeks.
All right, sounds good. Talk to you soon, Mike. Take care.
All right, we're going to jump to the charts here. Let me bring up my dash trader for a little bit of difference. I have converted to the blue background on dash trader, and I have some very good news from the technical perspective. That it looks like we have put in a short-term bottom. Now you would say to me, Michael, you're always so bearish. You're always looking at lower lows and lower highs and blah blah blah. Well, we have a low and we've put in a higher low. Okay, and now we are actually testing the point of control line here, which means that we may potentially punch through the midpoint of a W. And what that would do would probably bring us back up into this area of around 410, 405, but certainly around 400, which is the bottom. And I'm going to use my horizontal line to illustrate that. So this would be the level that I would expect the market to pop back up to. So I would expect the market to come back into this area. As soon as we break this midpoint of the W, we could probably pop back up to here at 407. It's not just the SPY, it's also on the Nasdaq. Nasdaq is also testing that midpoint, but the actual Nasdaq, if you notice, the lows have been shallower for a longer period of time. We have a low, lower low, lower low, slightly lower low, and then a higher low. We make a higher high. We could potentially be putting in a range for summer. And certainly depending on how things go with earnings season. But like I said, this is really a story of how well the management teams deal with quantitative tightening and how well they sell it to the public and sell it to the funds. But certainly AFRM, let's take a look at AFRM. So here is a firm had a really big day today, coming back to the upside. Potentially could get all the way back up to 30 if it punches through this midpoint. I'm going to look at Apple. Apple having a very strong day. So goes Apple. So goes the market. Certainly, Apple already broke through the midpoint. So that's a good indicator that the Nasdaq and the S&P will break through the midpoint. As I said, value stocks are also probably set to do well. So the Dow indicates a pretty good group of value companies. So you look at probably a move back. Certainly up to 318, but maybe even 325, 328, somewhere around there. You look at something like X. I mean, I was looking at this chart. I mean, look how obliterated U.S. Steel got. Really destroyed. U.S. Steel was up at $37. And now it's down to 17. It's lost over 50% of its value. Let's go to GBTC. Bitcoin having a good day. So this is GBTC. It represents the ETF that tracks Bitcoin. ETHE tracks Ethereum. Also having a fairly good day finally. So we have, these two cryptos doing well. Let's take a look at the old man, gold. Gold not having so good of a day. Gold finally breaking to the downside. So gold breaking down here, down to 162. Now, this is expected with the U.S. dollar strengthening. You don't want to be in gold. When the U.S. dollar is strengthening, gold tends to do poorly. U.S. dollar has been really the story. If you look at USO, right? USO, big pullback all the way up to this baseline where we broke out of on oil. So oil making a deep pullback. But I do think that overall oil probably is a buy for another move to the upside. And the rationale behind that is that I believe that probably there will be more problems with Russia, natural gas, and oil problems. Oil and natural gas shortages going into the winter. You have 300,000 NATO troops on the border. You have 2 new countries being entered into NATO. Sticking it to Putin means that Putin will probably want to stick it to NATO. And I think that going into winter is probably the time to do that best. So I would expect that we'll probably see oil and natural gas prices stay around these levels, but probably around October, November. Expect some little announcement that Putin shuts off the oil or natural gas to Europe. And that will certainly drive up the prices. But that, again, is a little ways out there. Let's take a look at UNG, which is natural gas. Pretty much the same picture, natural gas pulling back real hard and certainly hanging around these levels here. And that's pretty much the name of the game. Let me see if I can find XOM also pulling back. ExxonMobil had a really nice run and certainly pulling back. So that pretty much covers all the major companies. I'm going to take a look at AMZN. Amazon is now the new most popularly traded. I would say Amazon has put in a low base or a bottom. So I would really expect good things from Amazon. This is now the most popular. It was Apple before, but it is now the most commonly traded or gambled on option stock. So the options traders are really having a field day with Amazon. So keep that in mind. That it has now begun. I mean, look at the volume here since the split. I mean, it just, you can see the massive volume change. All right, I'm going to jump back and wrap things up for this week. That's it for market analysis. So stay up to date with all things DAS by signing up for our monthly newsletter and email. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel, Dash Trader TV, and the Dash Trader Newsroom reminders so that you are alerted each time we have a new episode. You could follow us on social media at LinkedIn, Twitter, Facebook, and Instagram. Just look for Dash Trader after the /. Thank you, everybody. I hope you had a wonderful 4th of July weekend and look forward to seeing you in 2 weeks. Bye-bye, everybody.